it's going to become probably more and more important that you're systematic in what you're doing and how you're thinking about the world and methodical in your decision-making process. Stick to some predefined rules in your financial life. Let markets do what they're going to do. SpaceX. Speaking of letting markets do what they're going to do. So does a bubble pop at 41, 44, or 63? Right? And the difference in your returns between 40 and 63 is massive. If you see a really good bull regime, bull market, what you want to see is small caps leading. So if interest rates were going to be coming down, the thing that tends to lead or should be leading in that case is small caps.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Lockups podcast. Today we are doing the May market recap for May 2026. What transpired, what's going on in the markets, and what should we be aware of as investors, traders, or allocators. Hang with me here today, and the thing that I'm going to cover at the end is the thing I'm getting the most questions about right now. And that is the SpaceX IPO. I'm going to give you some of my thoughts on that and some of my concerns here. So hang with us till the end on that. But I think before we talk about that, I want to talk about the things that I think are really going to be driving a lot of results for portfolios in general across the board and understanding what's currently going on. So listen, I like covering interest rates first. I think interest rates and bonds really do have a big impact on the world, the economy, and the way that we make decisions. Starting out here, let's look at mortgage rates. This is the 30-year mortgage index. So this is average 30-year mortgage rate. I flagged this down last month. I said, hey, interest rates had come down a little bit, but that I thought they were kind of bottoming out. They were going to catch some support and likely advance higher. They have advanced higher, and I think they're going to continue probably on that trajectory. We'll see what develops further from there. But I think that the takeaway from this here is it's reinforcing to me the idea that we are in a secularly high interest rate environment. Okay. Interest rates are likely to remain higher. And if, for kind of, it's flipped. All the people in the past, when you'd say like, oh, interest rates are going to come down. Interest rates are going to come down. Well, for years and years and actually decades, it was interest rates were going to come down. And so we'd be waiting for interest rates to come down. And I think going forward for the foreseeable future, beyond the foreseeable future, you're probably going to be more in a period of quick get the rate before they go back up, right? So the bias is towards the upside is the way that I would maybe explain that in interest rates. So when interest rates get low relative to where they've been, I would say don't get greedy if you're out trying to just manage your life or your business. And take what is a good workable rate for you and move on. I continue to hear people say that they're, holding cash back. They're holding money market. They want to remain liquid because they're just waiting for interest rates to come down and they're going to buy, real estate properties. And it's a really, really flawed, mechanical way of thinking about the world and the way that the interest rate environment is going to work. If you're in that situation, please revisit your financial plan and please visit with not just maybe a financial planner, but a really good investment advisor that can help walk you through the mechanics on that. Looking at the 2-year treasury, this drives some of your shorter term interest rates. Obviously very important to follow. Last month in the red, I circled and just kind of called out, hey, again, that looked like it was coming into support on a pullback after a potential breakout. And hey, it did march higher. So, the red circle is from last month, catching that move. I think it has certainly moved higher. I think again, we might get a little bit of a short-term, pullback from here in the 2-year for potentially a couple of days. I think again, the bias is towards the upside on the 2-year. So, We'll see what happens. This is all from a technical perspective, but again, I know the Fed wants to come in and, Kevin Warsh, the new Fed, wants to cut rates. Whether he can is a different story, right? And I'll point you to, hey, if they cut rates and they shouldn't, I think there's easy hedges to own in portfolios against the disasters that could cause. Let's look at the dollar. Again, I talk about this dynamic a lot. This is just a holdover chart from last month. Look, dollar rebounded last month, caught some support, but it's really not moving anywhere. It definitely seems to be in a solid channel, and we're rising in the channel currently. What's going to be really impactful is a definitive breakout across on the north side of 100, or a meaningful breakdown on the south side of 96. It's really important. If the dollar weakens, it's really positive for liquidity across the global economy. And if it breaks out to the upside, it actually tightens liquidity across the global economy. And that can have knock-on effects to asset prices. So if it breaks down, you want to own things like gold, international equities, potentially international bonds, assets that are priced in something other than dollars, right? So then you can pick up the tailwind of a depreciating dollar. If it breaks out to the upside, the last place you're going to want to be, in my opinion, is probably in international gold and international bonds. So it's just it works sort of both ways there. Same sort of trade. It just depends if you get a breakout to the upside or the downside in the dollar. Now, one of those assets I do think can coexist with a higher dollar, and that would be gold. So, look at your portfolio and try to understand what you own. But we're living in a different world with different markets than we have the last number of years. All right, let's talk really quick as we get into the stock market. There has been a huge rally off the lows in early April as part of the Iran conflict. Air quotes. But what I want to highlight is, like, if you see a really good bull market, what you want to see is small caps leading. So if interest rates were going to be coming down and we're just in an economic boom, well, the thing that tends to lead, or should be leading in that case, is small caps, right? So this is a Russell 2000. And what I want to call out here is this negative divergence or bearish divergence in momentum. As it's continued to come up here and make new highs, and it did have a great move off the bottom. It had a retrace here in May, and then and it's recovered for the most part, and it's pulled back just the last couple of days, but the momentum hasn't confirmed those new highs. And so you call that bearish or negative divergence. Now, divergences are tough, because you certainly could pull back a little bit, put in another high with even further divergence, right? And so not every divergence has to result in some sort of crash. However, I did call out similarly the S&P 500 doing the same thing. However, that divergence created, off the top of my head here, I think it took from October of last year all the way until February. So it took several months to wring out the market really rolling over and start moving down before we got the total sell off through March. And so small caps, in my opinion, here are not looking very healthy for continued participation. You might see continued participation to the upside, but if it comes with a further divergence, it's probably a further indication that you're that much closer towards a significant correction. So what is working in the markets? Well, the markets have exploded so much higher coming off the April lows that you can see in this chart here that no one wants downside protection. No one wants to buy the insurance, right? The fire has gone through and everyone says, my house didn't get hit. I'm going to cancel my fire insurance now. I don't care anymore. This is generally not a great thing to see for markets, and can typically coincide with some offsides positioning. However, here's the tough part about it, is that when you have no interest in buying downside protection, that doesn't mean that markets have to crash. It just means that it's a condition that should there be a catalyst, no one is, not no one, but people in general or portfolios in general aren't positioned to weather that or take advantage of it or to monetize potential convexity. And so it kind of gets everyone on the same side of the boat. Now, not a big deal unless a big wave comes, right? So a couple other indications and points to just coincide with what this looks like. So again, the purple line is actually just to smooth it out, is the 5-day moving average of the put call ratio. So when it's down, there's really not a lot of demand for puts. And when it's up, there is a lot of demand for puts. So, hey, what you can see is like at the end of March, there was a lot of demand for puts and it actually bled off. And then all of a sudden you saw the rally as it came down. You saw the massive rally in April, in May. It's now become just the skew underneath the hood on this is so significant. It's like a historical moment almost. So we'll see. Also historically, typically when they get this lack of downside protection need, I've seen some quantitative data sets today that called out, hey, when this has happened, the market is 20 times in history when it's gotten, this relatively close to this relative level. Market was higher 1 month later every single time. I don't know that 20 data sets is always significant enough of a data set to kind of call out a 100%, surety. All I'm saying is just because we're here doesn't mean markets now have to crash. It's a condition that's present, and it would lend to, hey, probably don't get greedy would be maybe the quick analogy or the quick lesson to take from this. The name exposure index, or the National Association of Active Investment Managers, in aggregate is now at a pretty, it's near where the peak normally is before things tend to roll over. However, you can see that it can stay at those sustained high levels for quite some time before it's anything significant. Just generally okay, right? Like people are allocated and the market's going up. It's okay. And then the RIDEX asset ratio, which is just measuring the RIDEX has both leverage long products and leverage short products. And so it measures sort of their ratio and assets under management in those funds to help determine how are people generally positioned. And so as the red contracts up, it means people are more bullish, or more people are more allocated to the long side of the market. They own the market rather than are short the market. And so there's not a lot of interest in being short here, which I don't blame people for not wanting to be short here. And I will tell you in just a second why I think it's a potentially really dangerous game. But before we do that, let's look under the hood at what's going on internally in the market. So we talk about all these lows, all these rallies off the lows in April, and May was a good follow-up month. However, if we look at the New York Stock Exchange Composite Index, so good gauge of the stocks that trade on the market, it's not hitting new highs. It still is not hitting new highs from its February high. It's this black line here. And what you can see here is in blues, this shading is the not advanced. This is the new highs minus new lows on a daily basis with a smooth 10-day moving average on that ratio. So what the blue's telling you is, hey, when the blue is positive and going up, it means more stocks are hitting new highs relative to new lows. When it's going down, more stocks are hitting new lows relative to new highs. So all else being equal, you want to see it rising. And it did do that the second half of last month, but after a pretty good corrective period to that. So we'll see. What I would say is the jury's out on breadth right now. If you're normally a breadth guy or gal and you're looking at just breadth, things I think could look a little bit confusing, especially considering how strong the market's been on the surface, but how some areas look weak under the hood. But if you equal weight the S&P, potentially FYI, the setup on that looks like it could be on a breakout. And so deciphering all this, it just is a bit of noise right now. My point is, under the hood, things are advancing, hitting new highs, but certainly not super confirming, right? So take that for what it's worth. Okay. So why is it a dangerous market to be short right now? And the answer is, like we are very potentially, I would say the potential of us being in a bubble at this point are relatively high. So we call it what you want, the AI bubble. This chart, which by the way was reposted by a friend of mine, Jim Bianco. Thanks, Jim, for flagging this. Just look, it's going over the different stock market bubbles in history and measuring them as a percentage of the U.S. market cap. So how concentrated did that bubble get on that one theme that drove the bubble? So back in the 1800s, the railroads at 63%. The utilities and telecom industrials bubble in the 1920s. In 70s, you have the Nifty 50, right? People are familiar with that, probably less so. Then you have the Japanese bubble, the Japanese equity bubble in the 80s, early 90s. That was pretty massive, largest stock market in the world at the time, I believe. Over here, you've got TMNT. Okay, i.e. like the .com bubble. And now you have the AI Big 10. So I guess we're going away from Meg 7. We're talking about the AI Big 10 stocks. And it's at 40%. So you're coming in really on where the peaks have tended to be. But guys, it's a bubble. Like here's the thing. The question becomes, so does a bubble pop at 41, 44, or 63, right? And the difference in your returns between 40 and 63 is massive. So as I continue to talk, if you're still listening to me, what you want to be thinking as we talk about this isn't, oh my gosh, I should get out of the stock market, or, oh my gosh, I should get invested in the stock market. You should be thinking, oh my gosh, I should be revisiting my financial plan with my financial advisor, professional, whoever, and making sure that I have an appropriate amount of risk in my portfolio, and making sure that I have an appropriate amount of reserves, particularly if you're coming in close to retirement or are in retirement and living off of your portfolio, right? So if you're living off your portfolio, make sure it's, calibrated to provide you that income, give you assets that you could liquidate and create your income, whatever you need to be doing according to your financial plan. Don't run out and, get me out of the market or get me in the market. If you're invested, let the investments do what they're supposed to. Change them if your financial plan says it's time to change them, right? Okay, if we take out the AI stocks, what's going on in the market? The quick answer is not much. Again, chart from Jim Bianco. Thanks, Jim. So the black line is the S&P 500. The blue line is S&P 500, but without the AI stocks. And what you can see is it hasn't come off of the peak in March before the sell-off. So the S&P, the stock market in general, without AI stocks has not hit a new high. It's quite lackluster in a lot of ways. Now, is it a feature or is it a bug? There's a lot of philosophical debate. It could go either way. But certainly what it means is you're either making money right now from the AI plays in the AI investments, or it's somewhat of a tough market. For diversified folks, it's probably a little bit of both, right? What you have to remember is that what goes up comes down at some point. And if it doesn't, then other things are probably likely to catch up to it, right? So again, I say, look, it's potentially concerning for some people. But what you want to do is stay the course, unless your financial plan starts to dictate that you should be doing something different. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. Okay, if we're talking about potential bubble regimes, Shiller PE ratio, we've talked about this a couple times. Okay, we're now at 42.66. Okay, its maximum reading in history is .com, December of 1999 at 44.19. Valuation is pretty dang high. The minimum in December of 1920 was 4.78. I would be absolutely shocked if we ever get back that low, ever even come close to it. But you just say like, okay, your median and your mean, so your average and your median, 16 or 17, you're well beyond double what the historical average is. So look, it's pretty high, but again, you have to realize, like, if it is driving returns in your portfolio, if you are allocated out this way, you have to think through your longer term consequences of potentially selling. Again, I think it's probably prudent to make sure that you're not overextended on risk. I think it's prudent to revisit your financial plan and say, do I need to be invested in this, right? If there's something potentially irrational going on markets, can I be invested somewhere else that I don't feel I'm taking the risk? However, behaviorally, what you have to appreciate and you have to understand is it's very, very, very difficult to do. And the reason why is if you look at 1997, okay, versus when the market peaked in early 2000, okay, I believe the NASDAQ had something like a 300% return in that time period, roughly. Now, if in 97, you said, hey, this is totally irrational, this is crazy, I don't need to be doing this, my retirement can, I want to retire in a couple of years or whatever. And, I could be making, 4 or 5% in, low risk bonds, whatever. And, I can be meeting my future obligations in retirement based on that return. I don't need to be doing this, right? And you could sell, reduce your exposure to the NASDAQ 100, your portfolio at that time. And the problem is that if it runs up another 300%, the odds behaviorally that any reasonable person at this point, I promise, this is so real in behavioral finance, you're not going to make it. You're going to hear about everyone making all this money, and the odds that you stick to your original resolve of, hey, markets are overextended, I'm good with 4 or 5% or whatever the number is, it's almost impossible. Isaac Newton, right, one of the smartest people ever, fell victim to this famously and reinvested into a bubble near its absolute peak after making a fortune, the fortune of a lifetime, right? Got out of the market, locked in his gains, and couldn't stand to watch his neighbors get rich and all his friends get rich in the bubble that kept expanding. And so he reinvested near the top, bubble popped, rode it all the way to the bottom, lost everything. And so just, that's a famous story, and don't fall victim to that. Just if you're invested, you want to make rational decisions, but the way to make a rational decision, if you're not a sophisticated, advanced trader or investor, is to let your financial plan help you dictate the timing, the terms, the how much, the allocations, right? And a good financial advisor should help you be able to walk through that. Okay, let's move on to SpaceX. Which, by the way, before I move on to SpaceX, you just continue on. I 100% am sitting here saying the market could absolutely go higher. And we're prepared that the market goes a lot higher, just because it's overbought, just because it's likely we're in a bubble. You just don't, the hard part about bubbles is super obvious in hindsight, really tough in the present. And I would say the amount of attention it's getting as a likely bubble probably leads me to believe, from a sentiment perspective, that we're probably somewhat early on in the bubble. And what I mean by that is, again, when everyone thinks you're in a bubble, it's tough for the bubble to pop because most people run quick to get the downside protection. They harvest their profits quick. From a sentiment perspective, the bubble is going to become really quite dangerous when people say it's not a bubble. These stocks really are worth that. The world really is going to grow at an insane double-digit rate every single year, and for in the indefinite future. And oh hey, a 10% pullback in stocks. That's what an amazing buy the dip opportunity. And that's probably when it's really quite over. It's when people think that it could never come down, and what they call it, capitulate to the upside, right? Everyone just buys in. Bubbles have a way of sucking everyone in. So it's going to become probably more and more important that you're systematic in what you're doing and how you're thinking about the world, and methodical in your decision-making process. Stick to some predefined rules in your financial life. And let markets do what they're going to do. Okay. SpaceX. Speaking of what markets are letting markets do what they're going to do. Here's an interesting one. I get a lot of calls about the SpaceX IPO that's coming up. I've been talking about this for a couple months now, and a lot of calls I get are from other financial advisors at other firms, friends in the industry, and I've gotten a couple calls from clients. Hey, should we buy it? Should we stay away from it? Both sides of the coin, right? Everyone's kind of got strong opinions about it. And what's interesting is there's a stock out there that I think you can kind of watch to gauge a little bit about what's going on with SpaceX, and that's EchoStar Holdings. EchoStar, about 50% of their assets on their balance sheet is actually just SpaceX stock. And so if you kind of think about it in a goofy way, EchoStar is kind of like a closed-end SpaceX fund, right? The price of this stock is, in my opinion, going to really closely match and be highly correlated to what happens to SpaceX under the hood prior to the SpaceX IPO. What you can see is there's some massive run-ups here. Last summer and last summer, two massive run-ups in EchoStar, right? All of a sudden in 1 week period, you have 61% return, and then 153% return, right? Just massive rocket. No pun intended. Okay, so it runs up, but guys, check it out. What you start getting, hey, here's this bearish divergence, right? This isn't super favorable. This is like not what you want to see in a technical perspective, a chart, right? Momentum's dropping, it's hitting new highs. We're getting closer to the IPO. Now, what we have to understand about the SpaceX IPO is a couple of things. Old saying on Wall Street, okay? If you can get access to the IPO, you don't want the IPO. And the reason why is why is it IPOing, and why do they want retail money, right? Like, why have all the big guys passed on it? Second, companies IPO not when it's to the benefit of the company. They IPO when they need to have some kind of liquidity, right? Now that can be liquidity for the company. They need operating funds. That's probably the most traditional way of utilizing the capital markets. That's what the stock market's for, right? It's a way to issue equities into the marketplace, right? And get cash in exchange for those, and fund business operations for growth or whatever it is. The second is you just need liquidity, right? So SpaceX in particular pays a lot of its employees through what they call equity compensation. So part of their paychecks is actually in one way or another forms of stock compensation. And so all these people that work at SpaceX, not all, but vast majority, have stock ownership in the company. Yeah, quite significant amount. So SpaceX is going to IPO with about 5% of its market cap trading. So quick numbers, if the whole thing was worth $100, they're only going to let $5 worth actually trade on the public markets. Now, this created a big problem in the dot-com bust. First brought to my attention by Mike Green when we were talking. It's been a while now. So there was an attribution in the dot-com bust. People said, hey, a good indication of a stock going up is its insider ownership, right? And so the belief was, or people looking for a fundamental reason to confirm what's happening with price is, hey, these companies are owned by the CEOs, they're owned by the people that work there, they're personally, they have a personal interest in the success of the business. And so their inside ownership is a good indication of, future value. And obviously the dot-com bust, went bust, or the dot-com bubble went boom, whatever you want to call it. And, what you had as a result is a couple of years later, they made the rule changes in the index funds. And what they went to, and people don't talk about this a lot, but we actually don't have a lot of true market cap weighted. In fact, I don't know of any true market cap weighted index funds these days. So if you think about like S&P 500, NASDAQ 100, Russell 2000, S&P 600, 400, the Russell 1000, the ACWIs, the MSCI indexes, all this stuff that's market cap weighted. What they did is they went to what's called a float adjusted market cap weighted. So in pre.com, if SpaceX was a $100 company and they IPO'd, it doesn't matter if $5 is what traded, they would include it in the calculations for the index inclusion as a $100 company. And that created a problem when now there's this demand from mechanical, forced, regular, passive buying that's trying to buy $100 of stock, but there's only $5 available. Well, that creates a massive demand relative to supply. The price becomes extremely inelastic and rockets up. Well, that's what happened in the dot-com. It was the predictor of inside. So the predictor of inside ownership wasn't true. What really was the predictor was low float, right? A low float with an index inclusion. And they solved this issue by making the float adjusted market cap weighted. So in the rules post.com, if a company was a $100 company and they IPO'd with $5 worth of their stock trading, it would only be included in the market cap index inclusion for $5 worth, right? As if their company was only $5, not $100. And that largely solved the issue for a while. I think there's a whole nother deeper conversation on to what extent, especially for companies that are more mature and have more of their float that trades. However, the thing that is going on in the markets that people maybe are not totally aware of around the SpaceX IPO is there's been a flood of rule changes into the index funds. And I would say two things can exist at once here, by the way. So first off, what I'm going to tell you doesn't mean it's like the end of index funds or that index funds are going to somehow blow up or this inherently, no matter what, causes some kind of market crash, right? The indexes could still go up. The indexes could still have a decent year. And simultaneously, the owners of index funds could be the absolute bag holder for SpaceX for a glorious, burning pile of just hot garbage that gets dumped on them potentially. I don't know that's what's going to happen, but it could. And let me tell you how. For a long time, there's been prudent advice that says, look, IPOs take 6 months to a year to settle down post IPO, find its real market price. And so the S&P 500, for example, had a 12-month rule. You couldn't include a stock in the index for 12 months, and it had to be profitable. Okay. SpaceX is not profitable, as far as I understand. And, even at that, You'd have to wait a year before it got included in the index. Now, that is again to protect sort of the index fund investors, right? To protect the index. So there's some rule changes. The NASDAQ, their rule was 90 days. Had to trade for 90 days. No profitability filter. Obviously, NASDAQ 100. Look at the stocks. But 90 days. And the Russell indexes, I think, was also 90 days. I got to double check on that. Anyways, okay, so S&P, this actually all started from my belief here with the NASDAQ, trying to win the IPO listing of SpaceX. And they said, hey, competitive advantage. Yeah, I'm making this part up. Just, by the way, I was not in the room. Trust me, I was not in the room for any of this conversation. This is my speculation. It sounded something like this. Hey, we want to win the SpaceX listing. A competitive advantage we have here at NASDAQ would be that we can change the index rules to make sure that your stock gets included in the index faster. We can do some indexation fast tracking. And that will help make sure the stock price stays high while all of your employees get out of their lockup periods before they are eligible to sell. So when they can go sell, a couple months in, the stock price is still high because the passive flows will come and continue to keep it bid up higher and higher. I think NASDAQ, I think that was a successful conversation for them. And what it led to then was S&P or Standards & Poor's at that point saying, wait a second, we're going to be archaic now. If there's our biggest competitor has SpaceX in their index and we don't, I mean, if that goes really good, like it's going to be even worse. The NASDAQ 100 has been beating us for years. And so they say, you know what, we'll change our 1 year rule. We'll go ahead and drop it down to 6 months. So they dropped their rule down, kept it a little bit more conservative. And then Russell said, oh my gosh, that's crazy. If NASDAQ is going to have to come buy all these shares, and then by the time the employees are selling, S&P is going to be buying all the shares from them, there's not going to be any shares around. So you know what? We'll beat them to it. We'll go 5 days post IPO. We'll start putting it in all the Russell, index funds it's appropriate for. And so now you have all the index funds rushing to buy it. Now here's the problem. Index funds are not in the business of providing superior returns to investors, right? That's just not inherently their business model. Their business model is to keep the fee on the fund as low as possible and provide the smallest amount of tracking errors humanly possible to the actual index, right? That's what an index fund is, their whole purpose in life. So what they don't want to do is potentially buy SpaceX early, okay, because you could have what they call a positive tracking error. Now, most of us normal Main Street investors would go, so if it's supposed to do 10% in the year, but the fund I bought accidentally did 12 because they bought something a day or two early, that's awesome. In reality, in the financial world and financial marketing, it's pretty bad. You don't want to have it because it means that you deviated from what you were supposed to have done. Likewise, you can't say, hey, SpaceX is so crazy, we're going to just omit it and not buy it because it's going to be such a big part of the index. I think at this point, it's supposed to be in slot like 2 or 3 in the S&P 500. It's so big and so dominant to the index that if you don't buy it, and you're going to have a massive tracking error, right? So if the company was supposed to be like 0.01% of the fund, hey, not a big deal, right? Like you could make a call that way, I guess. Have a very minimal tracking error still, but when it's supposed to be 5, 6, 7, 8% of an index, it's too much, right? So they have to buy it. Now the problem is this creates what I am calling a synthetic short squeeze. And what I mean by that is a short squeeze. Easiest example for people to see is most people will remember the GameStop short squeeze back in 2021. Okay, when you had a stock just absolutely moonshot because there was a hedge fund that was short the stock. It didn't own it. And a bunch of people started buying GameStop, and they bought and they bought and they bought, and the price started to climb. Well, at a certain point, the people that were short, there's only one way to close a short position. Okay. The reason it's called short is because you're short it in your inventory. You don't have it. And so as it goes up, you're going to get a margin call and you're forced to close your position. The only way to close a position is to buy the stock. So when you're short it, you owe a share to your broker. You have to go into the market and buy a share in order to turn around and give it to your broker just to close your position. And so what happens is as the market goes higher and higher and higher, you squeeze the short sellers that eventually have to become buyers. Okay. And it's called, like, there's a saying JC Pretz always has, which is, hey, a seller is a potential future buyer, but a short seller is a guaranteed future buyer. Because there is unlimited losses on the upside. And that's why shorting these kind of markets is so dangerous, right? You can put $100, you can short a stock at $100. And if it goes to zero, you stand to make $100. But if it goes to 1,000, you'll lose 900, or, you'll lose that 900 additional dollars, right? Which is more than you initially had to invest, right? And so you want to close that position. You have to close that position. Well, the index funds are synthetically short SpaceX, in my opinion, because they have to buy the stock. Okay. It does not matter to them what price it is. It does not matter if it's $100 stock or a $200 stock or a $300 stock or $400 stock by the time their rules say you have to buy this stock. And so the problem becomes this game theory question around, do people go and buy it on day one and day two and day three and day four and day five before it's included in the indexes, and they massively bid up the price and then just hold on to it, right? Because remember, if you want to really squeeze the short sellers, you just don't sell, right? If any of you guys can recall the GameStop thing, like all of the memes, right? The diamond hands, don't sell, hold on for dear life, like all of this stuff. And the reality is, like, people will end up, somebody out there is going to get massively hurt by this if it happens. And it's because, look, like, it runs up, but at some point it's done, right? And it tends to correct. The question becomes, does it correct on day 6? Does it correct on day 16 after it's in the NASDAQ? Does it correct in 6 months and 1 day after it's in the S&P? I don't know. I genuinely, I really don't know. All I know is that conditions are present for it to be extremely lucrative for somebody that's a very sophisticated and active trader. And it's very disastrous for somebody that is just thinks SpaceX is going to be a great company to hold on to for the next several years. Right. My personal opinion here is that it's probably not a great thing for markets, but that doesn't necessarily mean that it has to crash markets. Certainly, if you want to buy something in an index, you got to sell something in an index. So watch for a shakeup in that. I think to expect that the SpaceX IPO becomes disruptive to markets is relatively high. But again, disruptive and crashing markets is two different things, right? So you should remember, short-term volatility could be simply a nice opportunity. But we'll see what happens when IPOs. But that is my quick thoughts on the IPO. I think the last thing I would add, because I did talk about the market cap weighting adjustment, is that NASDAQ in their proposed rules change did propose a rule that if there was less than 20% float in the company, so if a $100 stock was going to let less than $20 trade on the market, that in the NASDAQ conclusion, they would give it what they called the 5 times multiplier. So if they gave a $100 stock, put $10 into the market to trade, for the index weighting, they would include it as a $50 stock. So that can have potentially reintroduction or reintroduce the effect from the .com bubble. But again, just as a reminder to everyone, like, markets can stay irrational longer than you can stay solvent, this sort of idea. If if things get pretty crazy, it's way, way, way too easy to say, hey, SpaceX IPO'd at $100 a share. It's 4 days later and it's $300 a share. Look at how dumb I am. I should have just bought it. I'm going to buy it now. And the reality is like, it could go to 900 a share. Almost certainly not that. If you think from a valuation perspective, I think it's like IPOing at $2 trillion. So that would put it at like an $18 trillion company. But it's just way too easy to say like, hey, I've got the FOMO now. I've got to buy, and and again, maybe it works out. Maybe it works out for you. But historically, that's not the likely case. So if you're going to mess with the SpaceX IPO, I'd say have a game plan. And I'd say, again, revisit your financial plan and say, how much money can I really put at risk? Because at a certain point, if you're playing this and you are not a highly sophisticated investor, and by the way, I don't mean like, sitting and doing some technical analysis or, you've traded some stocks successfully in the past. I mean, like, you're not sitting at a Bloomberg terminal. Good luck. Good luck to you. You might play it well, but is it, did you play it well or did you get lucky? Right. You can talk yourself blue in the face, convincing me that somebody was good at picking numbers when they won the lottery, right? They're lucky. There will be people that get lucky and make fortunes on the SpaceX IPO. I think the people that really make the fortunes are going to be the employees that get the exit liquidity and move on with life in some regard. But I can tell you too, that I've got friends that work in the space, that have a lot of employees at SpaceX, Anthropic, OpenAI, all these companies, and they are all constantly doing planning with these employees that never thought that they would make this kind of money. And their net worth is now significant, 10, 20, 30, 40, $50 million. And the appetite when you have made that much money in equity comp to say, you know what, I believe in the company long term, I'm going to keep riding it, is really low, guys. So the odds that people are going to be coming out of lockup on SpaceX, and that goes for any of these other large IPOs that are being planned, they come out of that and they start selling, and they sell in a significant fashion, and it causes a major disruption, and it probably really beats down the stock price. It's probably really significant. You want to be prepared for that opportunity, have a game plan around it, and don't take on risk in your financial plan that you can't afford to take on. So if that means what you have available is to, you want to gamble away $100 on trying to play the SpaceX IPO launch on your Robinhood app, Godspeed to you. If you're really wealthy and you can do $100,000, then, do $100,000. It's your call. But prudence pays in the long run. And I would not recommend people get out over their skis on the SpaceX IPO. So with that, bumpy rides ahead, I think, is a quick memo for the month. But stay the course unless your financial plan tells you to do something different. And with that, I'm going to call it a wrap, and we will see you guys out there. As always, feel free to reach out to us directly, dusharmwealth.com. I can reach out to the team, get a consultation on what's going on in your portfolio, help you dial in your financial plan if needed. We love to help people do that. If you're already working with us, we love to hear from you. We never hear from our clients enough. We just love you guys so much and are so grateful for you. So please give us a call, ask us what questions you have. If you're a lurker out there and you're just listening to my market updates, my podcast episodes, please drop a comment, send us an email. Hey, let us know you're there. It's always encouraging for me, keeps me going. But more so, if you have questions, you want to know about a certain topic or something that's going on in the markets, or a certain trend in finance, or a question about a type of financial product or strategy or whatever, send it in. I'd love to address it here on the podcast and help get people the education answers they're looking for. So with that, thanks again, everyone. I really do appreciate the trust and support. It means the world to me, and we will see you guys out there.